on our investment philosophy here at Konvergent Wealth Partners, which is really about helping our clients construct portfolios that can weather all seasons, meaning that we want to be able to make sure that no matter what is going on in the economic environment, we have components of your portfolio that are going to be working while others might not be. So combined all together, it's going to create a smoother overall ride for your investment portfolio. And really where this all stems from is when we look at the current economic and market environment, and really when we look back over the last 40 years, we've really been in a very unique kind of setting when it comes to the economic environment. If we look back at early 1980s, 1981, we really started this long-term bull market with extremely high interest rates, high inflation. We were coming out of a decade where we had really stagnant growth through the 1970s. And then we had an environment with lowering tax rates all through the 1980s up until now. And that was extremely supportive of a steady growth in our economy and really supportive of a strong overall stock market. At the same time, as interest rates went down through that 40-year period, because we started at such a high interest rate to begin with, bonds have performed extremely well over the last 40 years as well. And anytime we had a disruption in the stock market, your bond part of your portfolio was always there to save you. And so if you had a 60-40 stock to bond mix, you had a very good risk-adjusted return over the last 40 years. And so many people have come to believe that, hey, that's all we really need to do. Just invest in a passive stock market investments, passive bond market investments. And if you give yourself a long enough time frame, we're going to be okay. The problem that we've seen is really what's happened in that same 40-year time frame is really overall as Americans, we've had to move from savers to investors in order to achieve the rate of return we need to achieve our goals. And I'm going to illustrate that with this chart. And so if we go back to just 1995, in order to get an expected rate of return of 7.5%, all you needed to do was be 100% invested in bonds. And that 7.5% rate of return, when you think about what you need to achieve your goals, exceed inflation, most pensions and retirement plans use that number as kind of a good gauge. And you could do that with very little risk as recently as 1995. Fast forward 10 years to 2005, in order to get that same 7.5% expected rate of return, you now had to have 50% of your money in the stock market and 50% in bonds. And if you look at the standard deviation line, you move from a 6% standard deviation with bonds to a 9% standard deviation with this 50-50 mix. That's a 50% increase in the overall level of risk as measured by standard deviation. But let's move forward just 10 more years to 2015 to get that same 7.5% expected rate of return. You now had to move to close to 90% equities and only 10% bonds. And your standard deviation is now up to 17%, almost 3 times higher than it was in 1995, and about double what it was just 10 years earlier in 2005. And so that's where that comment that Americans had to move from savers to investors is that basically you could be very conservative with your investments through the 80s and even the early 90s and get a very safe and steady rate of return. And now you've had to move into very aggressive investments overall to maintain that same level of return. And what that, the implications of that to me, in my opinion, are, what's going to happen as we continue to get more market declines, as more and more people are having to stay more aggressively invested to reach their return goals. And where is this going in 2025? And just a few years from now, how much of your portfolio is going to need to be in equities just to generate that same expected 7.5% overall rate of return? So I do believe there are a lot of implications from this, and we're going to be doing a series of videos around portfolio construction and how we're thinking about this and how we're adding different investment allocations and asset allocations to the mix for our clients to try to basically deal with this potential future challenges that we see coming. So I look